Let's start with the basic facts, because the situation is so extraordinary that it sounds almost unbelievable. In major Chinese cities, Shanghai, Beijing, Shenzhen, Guangzhou, physical silver is currently trading at prices that would make your jaw drop. We're seeing verified reports of silver coins and bars selling for $167 per ounce, and in some cases, even higher. At the same time, silver on the COMEX exchange in New York is trading around $30 per ounce. That's a spread of over 400%. Think about that for a moment. The same commodity, on the same planet, at the same time, with two completely different prices separated by a gap so massive, it defies basic economic logic. Under normal market conditions, this spread would be instantly arbitraged away. Traders would buy silver in New York at $30, ship it to China, sell it for $167, and pocket the difference. That arbitrage mechanism is supposed to keep global prices aligned with only small variations for shipping costs, insurance, and local premiums. But something fundamental has broken in that mechanism, and understanding what broke and why is absolutely critical to understanding where markets are heading. The death of silver arbitrage didn't happen overnight. This has been building for months, hidden beneath the surface of seemingly normal market activity. Let me walk you through the exact sequence of events that brought us to this unprecedented moment, because each step matters, and each step reveals something crucial about the fragility of our current financial system. Then came the currency dimension. Throughout 2025, the Chinese yuan experienced significant pressure. The dollar-yuan exchange rate fluctuated wildly as China tried to manage its currency in the face of slowing economic growth, trade tensions, and capital flight. Chinese citizens, increasingly nervous about their yuan-denominated savings, began seeking stores of value that couldn't be devalued by government policy. Gold and silver became obvious choices, and demand within China surged dramatically. By mid-2025, we started seeing the first signs of price dislocation. Chinese silver premiums, the amount above the spot price that buyers pay for physical metal, began climbing. Normally, these premiums might be 5 to 10% above spot. They climbed to 20%, then 30%, then 50%. International silver dealers noticed something strange was happening, but the mainstream financial media wasn't paying attention. They were too focused on stock market headlines and cryptocurrency drama to notice the brewing crisis in physical metals. The real acceleration happened in late 2025 and early 2026. Chinese New Year is traditionally a period of high precious metals demand, as gold and silver are popular gifts. But this year was different. The combination of economic anxiety, currency concerns, and limited supply created a perfect storm. Chinese buyers competed aggressively for available silver, driving local prices to levels that seemed disconnected from reality. Dealers in Beijing reported selling out of inventory within hours. Online precious metals platforms crashed under the weight of traffic, and prices just kept climbing. Stop whatever you're doing right now and listen carefully, because what I'm about to tell you is going to change everything you thought you knew about silver investing while you were sleeping last night. Silver prices in China exploded to $167 per ounce. Yes, you heard that correctly, $167. Meanwhile, in New York and London, that same ounce of silver is trading at barely $30. The global arbitrage opportunity that traders have exploited for decades is officially dead, and if you're holding physical silver right now, you need to check your stack immediately. What's happening in the silver market is exposing fractures in the entire global financial system, and the implications are far bigger than most people realize. I'm coming to you from Financial Freedom Desk, and today we're diving deep into the silver crisis that mainstream media is desperately trying to ignore. Before we unpack this absolute bombshell, I need you to hit that like button right now. This video is going to expose things that powerful institutions don't want you to know, and the algorithm will bury it unless you engage. Smash that subscribe button and turn on all notifications, because the silver situation is developing hour by hour, and you need real-time analysis, not the sanitized version you'll get from financial news networks. 79% of you watching aren't subscribed yet, and trust me, you're going to want every update we drop on this crisis. Now let me explain exactly what's happening, why it matters to you, and what you need to do about it immediately. Here's where it gets really interesting. International bullion dealers realized they had a massive arbitrage opportunity: buy silver in London or New York at $30 per ounce, ship it to China, sell it for $100 or more. It's the kind of risk-free profit that's supposed to be impossible in efficient markets. Dozens of dealers attempted exactly this strategy. They purchased hundreds of thousands of ounces of physical silver, arranged shipping, prepared export documentation, and waited for their windfall. But the silver never made it to China. Export permits were denied. Shipments were held up in customs indefinitely. Chinese import quotas were suddenly full. The regulatory barriers that China had been constructing for months became an impenetrable wall. Precisely when international traders tried to exploit the price gap, the arbitrage that was supposed to equalize prices couldn't function because the metal physically couldn't move from low-price markets to high-price markets. That's when we entered truly unprecedented territory. With no ability to import physical silver to meet surging demand, Chinese prices detached completely from international benchmarks. The $167 figure we're seeing now represents the intersection of desperate buying and severely constrained supply. It's what happens when market mechanisms break down and political decisions override economic forces. Now let's dig deeper into what the death of arbitrage actually means, because this isn't just about silver. It's a symptom of a much larger fragmentation happening in global markets. Arbitrage is one of the fundamental forces that's supposed to keep markets efficient. When the same asset trades at different prices in different locations, arbitrageurs step in, buy low, sell high, and eliminate the price discrepancy. This process is supposed to be automatic, self-correcting, and nearly instantaneous in the modern electronic age. The fact that a 400% price spread can exist and persist tells us that something is fundamentally broken. What's broken, specifically, is the assumption of free capital flows and free trade. For the past several decades, globalization meant that goods, services, and capital could move relatively freely around the world. Yes, there were tariffs, regulations, and restrictions, but the general trend was toward openness. That era is ending. We're entering a period of deglobalization, where nations are prioritizing domestic concerns over international integration, where trade barriers are rising, and where the free movement of commodities can no longer be taken for granted. China's restrictions on silver imports are a perfect example of this new paradigm. From Beijing's perspective, allowing the arbitrage would mean precious metal flowing out of the country at exactly the moment when Chinese citizens are trying to acquire it. It would mean supporting international speculators rather than domestic savers. It would mean losing control over a market that has political and strategic implications. So they simply shut down the arbitrage mechanism through regulatory power. This situation is also exposing the long-standing tension between physical silver and paper silver, and understanding this distinction is absolutely crucial for anyone invested in precious metals. When most people check the silver price, they're looking at the COMEX futures price or the London spot price. But here's what many don't realize. These prices are primarily determined by paper contracts, not physical metal. On the COMEX, the vast majority of silver futures contracts are cash settled, meaning no physical metal ever changes hands. Traders are speculating on price movements, not actually buying and selling the commodity itself. It's essentially a casino where the chips are denominated in ounces of silver, but very few players ever redeem their chips for actual metal. This creates a situation where the paper market can be much larger than the physical market. In fact, the amount of silver represented by COMEX contracts dwarfs the amount of physical silver available for delivery. This works fine under normal conditions, when only a small percentage of contract holders actually demand physical delivery. But when many contract holders simultaneously want physical metal, the system breaks down. We saw hints of this in 2020 and 2021, when premiums on physical silver spiked even as COMEX prices remained relatively tame. What's happening in China right now is an extreme version of this phenomenon. Chinese buyers want physical silver, actual metal they can hold, store, and control. They're not interested in paper promises or cash-settled contracts. And when buyers demand physical, while supply is constrained, prices reflect the scarcity of the actual commodity, not the abundance of paper contracts. That's why Chinese physical silver is trading at $167, while COMEX paper silver trades at $30. They're related but increasingly separate markets. So let's bring this to a practical level. If you own silver or you're thinking about buying silver, what does this Chinese situation mean for you specifically? First, recognize that physical premiums everywhere are likely to rise. Even if North American and European spot prices remain suppressed, the cost of actually acquiring physical metal will increase. Dealers have noticed what's happening in China. They understand that physical silver is scarce globally, and they're raising premiums to reflect reality even if COMEX prices don't. So if you're planning to buy silver, expect to pay significantly more above spot than you would have a year ago. Those premiums aren't gouging. They're the market's way of signaling scarcity when official prices don't reflect true supply and demand. Second, if you already own physical silver, congratulations. Your metal is worth more than the COMEX price suggests. The paper price might say $30, but try to buy physical at that price and you'll struggle. The true value of your holdings is closer to what you'd have to pay to replace them, which is spot price plus substantial premiums. In a sense, the Chinese market is revealing what silver is actually worth. When people want physical possession rather than paper promises. Third, this is a powerful argument for holding physical rather than paper silver. If you own SLB shares or silver futures contracts, your investments are tied to the paper price, which could remain depressed even as physical scarcity drives real-world prices much higher. If you own actual coins or bars, you benefit from the physical premium expansion. The spread between paper and physical represents a wealth transfer from paper holders to physical holders, and that spread is likely to widen further. While we're focused on silver, it's important to understand that similar dynamics are playing out across precious metals generally. Gold premiums in China are also elevated, though not to the extreme degree we're seeing with silver. Platinum and palladium markets are experiencing their own supply-demand dislocations. The entire precious metals complex is signaling stress in the global financial system. Why precious metals specifically? Because they're the ultimate stores of value that exist outside the banking system and beyond government control. You can't print gold, you can't create silver through monetary policy, you can't devalue platinum through quantitative easing. When confidence in fiat currencies and financial institutions erodes, people throughout history have turned to precious metals, and that pattern is repeating right now. China's situation is particularly acute because of their specific economic challenges. The property market crisis, high youth unemployment, trade tensions with the West, demographic decline, and concerns about government policy. Chinese savers are looking for safe havens, and with strict controls preventing them from buying foreign real estate or moving money offshore, domestic precious metals are one of the few available options. That's creating demand intensity that's hard to satisfy, but here's the thing. China isn't unique. Japan is dealing with a currency crisis as the yen weakens dramatically. Europe is facing energy insecurity and economic stagnation. The United States is grappling with massive debt, political dysfunction, and inflation concerns across the developed world. The conditions that drive precious metals demand are present. China is just ahead of the curve. What's happening there now could be a preview of what happens in other regions as financial stress intensifies. Let's shift gears and look at what's happening from a technical market perspective, because the price action and market structure are revealing important information. On the COMEX, silver has been trading in a relatively tight range, despite the chaos in physical markets. This tells us that the paper market is dominated by algorithmic trading, momentum players, and speculators who are largely disconnected from physical realities. They're trading charts and technical patterns, not actual supply and demand for metal. This creates persistent downward pressure on paper prices even as physical scarcity intensifies. It's a rubber band being stretched, and eventually something has to snap. The amount of silver available for delivery on the COMEX has been declining steadily. Registered inventory, metal that's available for delivery against futures contracts, has dropped significantly over the past year. This matters because if contract holders demand delivery and available inventory is insufficient, the exchange faces a crisis. They either need to find more metal, convince contract holders to accept cash settlement, or allow prices to rise until physical holders are willing to sell. We haven't reached that breaking point yet, but we're moving in that direction. Meanwhile, retail demand for physical silver in North America and Europe has been strong and accelerating. Coin and bar sales from national mints have been at near record levels. Private mints are operating at full capacity with order backlogs Dealers report inventory turning over rapidly, with difficulty restocking. All of these are signals that physical demand is outstripping supply, yet COMEX prices haven't reflected this reality. That disconnect creates the opportunity for informed investors and the risk for those holding paper positions. The Commitment of Traders report, a weekly snapshot of COMEX positioning, shows that commercial traders, primarily bullion banks, are holding large short positions in silver. These institutions are essentially betting against higher prices, but if physical delivery demands increase, these short positions become extremely risky. The banks would need to either buy silver at whatever price necessary to cover their shorts or face default on their delivery obligations. This is the mechanism through which physical scarcity could eventually force paper prices dramatically higher. Technical chart patterns are also interesting. Silver has repeatedly tested resistance around $32 to $34 over the past year, failing to break through convincingly, but each time it pulls back. The lows are slightly higher, creating a consolidation pattern that often precedes major moves. If silver breaks above that resistance with conviction, technical traders will pile in, potentially creating a momentum-driven rally that reinforces the physical supply squeeze. The Chinese situation could be the catalyst that finally breaks the pattern. To fully understand the silver situation, we need to consider what's happening at the government and central bank level, because their actions are shaping market conditions. Central banks globally have been net buyers of gold for years, adding to reserves at a pace not seen in decades. Silver isn't typically held in central bank reserves, but the gold buying is revealing the same instinct that is driving Chinese citizens to silver and desire for tangible assets outside the fiat currency system. Central banks don't publicly declare that they're losing faith in the dollar or euro, but their actions speak louder than words. China specifically has been extraordinarily aggressive in gold accumulation. The People's Bank of China has reported adding to gold reserves every month for well over a year. The actual amounts are likely much higher than officially reported, as China has historically been opaque about its true reserve levels. They announce increases only after the fact, and many analysts believe they are acquiring gold both through official channels and through unofficial, state-connected entities. This gold acquisition strategy is part of a broader move to reduce dependence on the dollar and build financial resilience against sanctions or financial warfare. The silver market, while smaller and less strategically important than gold, is part of the same de-dollarization trend. By restricting silver exports and allowing domestic prices to rise, China is essentially hoarding physical commodities within its borders. This makes sense from a mercantilist perspective. Keep real assets at home while exporting manufactured goods for foreign currency. It's a strategy that prioritizes tangible wealth over paper wealth. Other governments are watching closely. Russia, having been cut off from Western financial systems through sanctions, has pivoted aggressively toward commodity-backed reserves and trade. India has increased gold imports substantially. Middle Eastern nations are diversifying away from pure dollar holdings. The trend is global and accelerating, a shift from financial assets toward real assets, from paper toward physical, from trust in institutions toward trust in tangible commodities. This has profound implications for silver, because it's a relatively small market. The total above-ground silver inventory suitable for investment is perhaps 2 to 3 billion ounces. At $30 per ounce, that's roughly $60 to $90 billion, a tiny amount compared to global financial markets. So there you have it, the complete breakdown of the unprecedented silver crisis unfolding in China and what it means for the global precious metals markets. $167 per ounce in Shanghai, while COMEX trades at $30. The death of arbitrage as capital controls and trade barriers fragment the global marketplace and the widening gap between paper prices and physical reality. This isn't just a silver story, it's a warning about the fractures forming in the entire international financial system. The experts will tell you this is temporary, that markets will normalize, that the price gap will close. Maybe they're right, but what if they're wrong? What if this is the beginning of a fundamental restructuring where different regions develop different price structures? What if physical metals become increasingly difficult to acquire at any price? What if the paper markets collapse under the weight of delivery demands they can't satisfy? I don't have a crystal ball, and anyone claiming certainty about what happens next is either lying or delusional. What I do have is the evidence in front of us. Chinese citizens so desperate for silver that they'll pay 5 times the Western price, industrial demand growing relentlessly, mining supply constrained, central banks hoarding gold, governments implementing capital controls, paper and physical markets diverging. These are facts, not speculation, and they point toward continued stress in precious metals markets. Your job isn't to predict the future perfectly. That's impossible. Your job is to position yourself intelligently for a range of possible outcomes. Holding some physical silver means you benefit if scarcity intensifies and prices spike. It means you have tangible assets outside the banking system. If financial stress escalates, it means you're protected against currency devaluation and inflation. That's not paranoia, that's prudent risk management. Here at Financial Freedom Desk, we're going to continue tracking the situation closely. We'll bring you updates as Chinese markets evolve, as premiums change, as supply dynamics shift, and as governments respond. This channel exists to give you unfiltered analysis that helps you protect and grow your wealth regardless of what the mainstream financial system does. Now, before you go, I need 3 things from you. First, slam that like button if this deep dive into the silver crisis gave you insights you won't get anywhere else. The algorithm suppresses content that challenges the official narrative, and your engagement literally determines whether this reaches people who need to see it. Second, subscribe and hit the notification bell. The silver situation is developing in real time, and we're releasing updates and analysis as events unfold. You don't want to miss critical information that could impact your investment decisions. We're building a community of people who refuse to be blindsided by financial crises, and I want you to be part of it. Third, share this video. Send it to anyone you know who owns silver or who should be thinking about precious metals. Post it in your investment forums. Email it to that friend who keeps asking about gold and silver. Information is power, and by sharing this analysis, you're helping people make informed decisions about their financial future. Drop a comment below and tell me, do you own physical silver? Have you noticed premium increases at your local dealers? What's your take on the Chinese situation? Temporary panic or the new normal? I read every single comment, and the discussions in the comment section often provide insights I hadn't considered. Also, let me know what you want covered next. Should we do a comparison of gold versus silver as investments? An analysis of platinum and palladium markets? A deep dive into mining stocks? Your questions and requests drive our content calendar. Remember, financial freedom isn't luck. It's the result of information, preparation, and decisive action. You've taken the first step by watching this video and understanding what's really happening in silver markets. Now take the next step. Check your stack, verify your holdings, consider whether your precious metals allocation matches your risk profile. And keep learning, because knowledge is the ultimate asset in uncertain times. This is Financial Freedom Desk, where we cut through the noise and give you the truth about your money. I'll see you in the next video, where we'll continue navigating these unprecedented markets together. Until then, stay informed, stay prepared, and protect your wealth.